When combining fibs from multiple time frames, I suggest in particular to combine two fibs, one large fib and one small. No more than two fibs because it can become redundant and or confusing as the chart gets more cluttered. This example of FedEx stock demonstrates several features of combining a large and small fib that increase success. Focus special attention to the reversal in the 220s, occurring from June to July. The support zone in the mid-220s was identified as a major area of significance since at least late April. This area emerged as the most critical support zone, where a major reversal was likely to occur due to several factors. First, let's begin by explaining the formation of this key support zone. Near the end of 2017, the broader area in the low 230s to low 220s acted as a strong resistance with several small reversals. Eventually, this area was passed to reach new highs with higher than normal volume and price movements. Even before drawing a fib, the large amount of significant price action and volume presented were early indications of an important zone. The second major indication emerged when FedEx and all global stock markets had a sharp downtrend from late January to early February 2018. The reversal of this significant downtrend would be important even if it was just isolated to FedEx stock. However, since the sharp downtrend was also seen across stock markets around the world, this added extra importance to the downtrend and subsequent reversal back up later in February 2018. Regardless of the fundamental influences behind the price action, the chart displayed enough price information to draw both fibs from mid-February to early March. The key points to reference here are the highs in early 2018 at the 270s and the lows in early February in the 220s. After drawing the two fibs, the effective range could be increased, as we can see by the swing points from which trend lines could be drawn after early March. Given the prior price action in the mid-220s, and the close proximity of a large and small fib level in this range, a major area of significance was identified by the end of February. The swing lows in late March, with high volume near this level, also added greater validity. This second swing low in late March didn't touch the exact fib levels in the mid-220s, because the previous swing low in early February was on exceedingly high volume and a large price move. This led to the supporting force raised slightly above the fib levels. The lining up of these two fib levels with significant reversal areas formed a strong and relatively narrow support zone. The 226.12 level represents favorable support conditions for buyers, right in the middle of the range formed by the two fib levels, and alignment with important reversal areas. In theory, the area covered by fib levels from both the large and small fib are the most significant price ranges where reversals are more likely to occur. Areas of support and resistance identified by a single fib are generally less significant. However, as we can see, this is only partly true. Case in point is the downward reversal at the single small fib's 0.786 level in early June, placing greater importance on price zones just because they are formed by levels from a large and small fib is not enough. To further increase success, we need to determine which fib levels are more relevant. To do this, we first look at the areas where fib levels from the large and small fib are very close together. In this case, 3 levels, the mid 270s at the 1 level for the small fib and 0 level for the large fib, the mid 240s at the 0.382 level for the small fib, and 0.236 level for the large fib, the mid 220s at the 0 level for the small fib, and 0.382 level for the large fib. Naturally, combining of levels from both fibs outlines a rough price or price range where reversals are even more likely to occur. Out of the 3 price areas mentioned before, the one in the mid 240s can easily be disregarded as a relevant and major reversal zone. Even though it is a zone formed by a large and small fib level, it was never the site of a major reversal for the length of the chart. This is not to say it should be ignored completely. Rather, it has lower consideration when compared to the mid 270s and mid 220s, where moderate to major reversals can clearly be seen. This builds on concepts of the confirmation triangle to further increase reliability and help to narrow down which price ranges warrant more attention. Specifically, this example highlights the importance of referencing to see if the fib levels also line up with past reversal areas. It is also not reasonable to emphasize certain price levels or ranges just because one or more fibs approximate a certain price range. Using additional methods such as checking to see if past reversals occurred at that level or zone serves to improve reliability and success with fibs. When looking at reversals that occurred at price levels from only one fib, here it is the small fib, we notice some key features. These reversals line up with price ranges that have had one or more reversals clearly visible. In this example, we can see them on the small fib at the 0.618 fib level at 256.50 in April, at the 0.236 fib level at 238.33 in early May, and at the 0.786 fib level at 264.48 in June. The first 2 reversals could have easily been confirmed with greater accuracy because they lined up with past reversals at those fib levels too. The third one at the 0.786 level is a special case. It would appear there were no reliable additional methods to confirm a reversal was more likely to happen at that fib level. However, there was a clear reason, that being price was becoming overextended. Generally, price can move through 2 fib levels on normal volume without stalling or reversing. Once price moves to 3 fib levels without stopping to stall or reverse, the chances of a reversal increase significantly. If there is a reversal, it is also likely to be larger. This is because price cannot normally maintain movement in one direction for more than 2 fib levels without at least a brief increase in volume to sustain the trend. On this chart, price continued an uptrend after reversing off the 0.236 fib level for 4 fib levels to the 0.786 fib level. Additionally, this extended uptrend was also on normal volume, with no major increases in volume in the period from May to June. Since volume was normal here, price was on a healthy uptrend for at least 2 fib levels, but after that, the absence of major increases in volume indicated unsustainable upward movement. Price did begin to stall between the 0.5 and 0.618 level. 3 fib levels had been passed, and the uptrend was becoming overextended. Eventually, after stalling at the 0.786 level, price regressed back to normal behavior, and the inevitable reversal back down came due to the absence of no major bullish volume spikes to sustain the uptrend. The downtrend off the 0.786 level moved down 5 levels to 0 in the small fib. At that point, the downtrend became overextended and reversed. Price movements in a fib can be thought of like an elastic band. The further price moves or stretches, the greater the chances are a rebound will occur. And the chances of that rebound being a large reversal are also greater. Overstretching begins after price has moved through 3 or more fib levels without an increase in volume to sustain the trend. Lastly, a small note about trend lines. Specifically, using the trend line from the confirmation triangle as a sign of a future reversal area. On this chart, it would be the reversal in early May on the small fibs 0.236 level. Trend lines can be used from the confirmation triangle or drawn separately to indicate the general area and time a reversal could occur on a particular fib level. This is just a minor additional method to enhance fib reliability. Trend lines are useful but not necessary. They are often misinterpreted and misused because they are easily drawn. All you need is 2 or more swing points to run a line through. 2 points on a chart can easily be manipulated to draw a line that will indicate any area you want to be a reversal area. Use trend lines carefully and sparingly in a fib.